Hi, and welcome to the second quarter 2025 investment update from the San Diego Foundation. I'm Matt Fettig, Chief Investment Officer at the Foundation. The second quarter was one that was very much marked by turbulence. Remember Trump's Liberation Day, or the day that tariffs were announced across several countries, really wreaked havoc on the market in March and into early April. But things did turn around, and the second quarter actually finished up very, very strong. We had more robust GDP growth than we thought. And while inflation was still an issue and potentially still is today, there were not signs of major inflation as a result of Liberation Day or any tariff policy. Now, that is so far. We don't exactly know how that will end up. And with the Fed likely to cut interest rates here in the month of September, it will certainly be an interesting time and probably a volatile time moving forward. So let's talk investment results for the quarter and certainly year to date. And we'll start with the endowment portfolio. The endowment portfolio was up 6.1% for the second quarter, a relatively strong result, and up about 5.7% so far year to date. A few things to really emphasize here. As you know, we've been big believers of not only owning stocks inside the U.S., but outside the U.S. for diversification purposes. In fact, international stocks have outperformed the U.S. so far to date. It'll be interesting to see as interest rates begin to decline here in the U.S. per Fed policy, if that rally can continue. So for the quarter, we were up 6.1%, and that was really a result of stocks rising across the board, both U.S. markets, non-U.S. markets, and emerging markets. The detractor we had from performance is real estate. You've heard me say that before. We had very strong results in real estate. And as you recall, in 2022, as rates went from zero up dramatically, a lot of real estate had issues. Now, what we own are more apartments and industrial properties, and those have been much more protected in this kind of negative real estate market environment. And there has been some stabilization across real estate, but what we're seeing is a lot of our managers slowly marking down the assets they continue to hold. Hopefully, we will see some stabilization there soon, as real estate was really one of the best performing areas of the endowment portfolio for almost 10 years. Now, as we look out at longer term results, you see the endowment has outperformed its policy index for 3 years, 5 years, 7 years, and 10 years, and has that robust return that we are looking for from the endowment. So let's move to the long-term portfolio. It was up 7.2% for the second quarter and 7.4% for the year through June. Once again, themes are very similar. We had very strong performance out of our stock managers. Non-U.S. stocks outpaced those here in the U.S. Our fixed income managers or bond managers also performed quite well. In fact, we saw a rate of return year over year of above 6% for bonds. And it's been a long time since we've seen that robust return from that segment of the market. Hedge funds were also relatively strong, while real assets were a modest detractor from performance. Over the longer term, you can see we are also outperforming our policy index over 3, 5, 7, and 10-year periods. Next, the medium-term portfolio. Remember, this is about 25% stocks, 75% bonds. The strength that we had in the fixed income or bond market really led this portfolio to outperformance for all time periods, and particularly so over the course of the last year. We know the stock market has also been strong. Real assets were kind of a mixed bag. The intermediate term portfolio is 100% bonds. And like I said, we've had great strength with our bond managers outperforming And you can see that reflected here, outperformance really over all time periods. And finally, the short-term portfolio, up 1% for the second quarter, up a little over 2% year to date through June. Remember, this portfolio consists entirely of money market funds, so it is highly correlated to short-term interest rates. So we've had some good results here, particularly compared to the period when short-term rates were at zero. That being said, it does look like the Fed may be ready to move and lower short-term interest rates. That will have an effect on the yield of this portfolio. So switching gears, we'll talk about the two sustainable portfolios, the sustainable endowment and sustainable non-endowment portfolio. These portfolios are really structured exactly the same. They might have modest differences in investment performance, and that's really due to cash flows in or out of the portfolio. Remember, this portfolio had some difficulties in an upward market for stocks, really because our global stock manager was underperforming. We made a change. It's almost been, a year and a half since we've done so, and results have gotten much better. You can see these are actually the strongest performing. That's really a result of just the amount of global equity or stock exposure that we have here in this portfolio. It does make up over 75% of the portfolio. And as you all know, performance of the stock market has been good, really across the board recently, including US and non-US stocks. The portfolio was just a tad behind over the last quarter, ahead for the year-to-date period, a tad behind for the 1 year. And I already kind of mentioned the history of the longer-term numbers. Hopefully those will improve over time. If you need more information, you can always go to sdfoundation.org/investments. All of this information is there for you. Thanks so much for joining us.